Morning, everyone. Welcome to this morning's edition of the NBC Markets Morning Call. It's the 23rd of July. The market was down and we had Google after the bell today. The risks are just piling up. Iran's escalating as well. We've had the Houthis attack some Saudi ships in the Red Sea. Google raised the Capex concerns that we're talking about, and really did think that they would be the ones that, probably were not, that we're probably going to do better than most overall. But obviously, you saw a little bit of money switch back to the more defensive names. Nvidia did okay last night. There wasn't really any news around that. There was a story from OpenAI last night where one of their sandboxed AI experiments, one of them managed to get out and hacked a competitor website. So there's a little bit of concerns there around, what AI can do, etc. But I mean, how much truth there is to that? I mean, these things always seem to line up with when Anthropic or OpenAI are doing a cap raise, I've got to say. So how much truth's in them is a completely different matter. And whether the AI did it or whether someone just screwed up at a human level is a completely different matter as well. But that doesn't write good clickbait stories overall. So the S&P was largely flat, really muted session because everyone was waiting for Google. As I mentioned, the Houthis attacked 2 Saudi tankers, and the Red Sea was Saudi Arabia's key bypass area, and that's where they've been using that pipeline to ship about half their flow across. But now they're going to, you can't get to Asia without going around around the bottom of South Africa, what is it, Cape Horn or whatever it is, that puts some pretty significant time delays on oil. It's WTI up around $90 now, and then Brent's nearing 100 as well. I think that the time for investors just burying their heads in the sand and just assuming that everything's going to be okay, very much nearing an end, I would imagine. In terms of Google or Tesla had horrible earnings as well, but realistically, Tesla's pretty spotty on earnings regardless, so I'm not going to really go into that. It's way too complicated. It's all about forward earnings. They're talking about it being wrapped up in space. It's just too complicated. So, if you want, it's much. If you're really interested in that, and you're invested in Tesla or you like Tesla, you're aware of all this. But big concerns here with Google. So we'll start with the positives. Cloud was the star, 82% revenue growth over year on year, and it was a slight beat by what was it, 2.4 billion. Backlog hit 500 billion. Nearly 90% of Fortune 100 now on Gemini Enterprise. There are concerns over the model, though. Gemini Pro is still really delayed. It's losing ground in the AI coding to Anthropic, OpenAI. Obviously, there was the Kimi release as well, but I mean, no Fortune 100 company is going to use Chinese stuff. Even if they wouldn't be allowed, I wouldn't imagine. But they have started doing some training on the new Gemini 4. There's the next frontier bet. Look, they beat top line and EPS for this whole earnings season. Let me just tell you, just straight up now, with these hyperscalers, it's about Capex, EPS and things is great and all, but and even with the cloud, realistically, Anthropic's on this model and Anthropic is killing it. There's a lot of skepticism around Google, the usage of Google's Gemini, because they include what the search engine numbers as well. So they've sort of got, I mean, those numbers are, you've got the best in market at the moment helping grow their cloud. And I've got to say, everyone that I heard talk about it on Bloomberg and on various platforms this morning was pretty underwhelmed. They're like, yeah, 82% is great, but it's not them necessarily that's driving it. But the Capex really did spook the market. Raised their 2026 guidance to around the 200 billion from about the 185 billion. They reported their first ever negative free cash flow quarter, and all of this, and again, concerningly, all of this was left to the earnings call. Like, they left all the bad news out, which just sort of reeks of them trying to hide bad news. Well, they knew it was bad news because they've mentioned this stuff before in the top line when it was good. So, and like this is a big trend where free cash flow going negative for most of the hyperscalers because of this capex spending. And look, that's not a but this is why Oracle got belted like 40 or 50% was they went free cash flow negative. Amazon, I think it's the biggest revenue earner in the world, so it wasn't as affected, but it's not good. It's money, like, and yes, they've got to invest, but like shareholders want to see results, and these sorts of triggers are big screeners for some of these companies. And I think that I thought Google was going to be one of the better ones, and it was up around about 1% on the headline stuff, all the good news. But then, as soon as the earnings thing started, so that's just raising this year's guidance. I mean, if they raise next year's, which was 300 billion, and with the likes of all the memory chips and things heading higher, and they reckon that an absolute large chunk of inflation at the moment is all to do with these data centers. It's not going to improve, I wouldn't have thought, just on supply shortages and high levels of demand alone. So yeah, not a great start to earnings, I've got to say, because I would imagine that Meta and Amazon and Microsoft won't read as well as this. So because these guys haven't gone too nuts on GPUs and things like that. They've used inference chips. They're pretty good on general tech, and it's a little bit concerning for mine. So as I say, that's it. Sorry, that's actually the incorrect one. What do we got here? Yeah, S&P down 0.46. The Nasdaq was down, 0.14. Nasdaq was down a half. I would imagine futures at this point will be down as well. I'll just have a quick, check of that in a minute. But yeah, Google got down to being down 5% at one stage. US tech's not down that much, I've got to say. And I think Google finished somewhere around the down 3% mark. So down around about 4.5 for the day session and the post market session combined. Obviously, commodities and real assets, we're starting to see a bit of an uplift, with 10% up for the week and for the last 5 days now for crude, as I mentioned before. And like I say, the risks are just starting to stack up a lot here. For those of you who follow me on Livewire, etc., I sort of wrote an article about this about a week and a half ago. You combine with this that margin lending levels and the use of these 3 times ETFs from retailers are just at absolute record highs. Then add this whole buy the dip thing. If you're maxed out on the credit card for leverage as a retail investor, you add to that a lot of the cash has been sucked up by these corporate bond issuances from the hyperscalers. Fund managers are sitting below that critical 4% cash mark at 3.5% cash. So you get a margin call, and then the fund managers don't have money to buy the dip, and no one can buy anymore because they're already maxed out. It's never a good combination, and and now we've got 2 straits closed, which is actually a worse scenario than when we had the war at its full scale last time. It's a miracle this market's not down a hell of a lot more. And if you've got any form of risk management, I'd be reviewing your portfolio as soon as humanly possible, particularly coming into ASX earnings with ASX stocks. Downside hits were 30 and 40% last earnings season, and if you smashed it out of the park, you were barely able to go up 10. So, and there's all new tax laws, etc. for Australia. If there was ever a time to review your portfolio, I can't think of a time that's better than now, because absolutely everything has changed. So yeah. We got Eli Lilly, and RTX, I believe tomorrow or tonight. We've got a fair bit next week as well. You got, you can see here, Coca-Cola, a couple of the major defense, but Meta, Microsoft on that, middle of the week, and Apple and Amazon as well, and then the oil majors, and then we started to see some of the Aussie stuff with Fortescue as well. So, things are starting to heat up. If you want a portfolio review, we do them free of charge. We've got our own in-house software that we developed, proprietary software that we developed called Prism. Just go to the website, mpcmarkets.com.au. You just upload your portfolio, and we'll get back to you in 24 to 48 hours. So it's no big deal. In the old days, it was a big deal because it used to take me half a day, but it doesn't take as much time anymore. And you'll get one of the guys here will deliver it to you. Podcast this week will be pretty interesting. I think we haven't decided on a topic as yet, but we did talk about the chip stocks last week. Kai went into the weeds as he does, but there's no better man to go into the weeds on this sort of technology stuff than him. On your favorite podcast platform, Spotify, YouTube, Apple Podcasts, iHeartRadio, you name it, it's there. mpcmarkets.com.au/podcast. You can find them all. A bit of an in-depth sort of 50-minute outlook on what's going on in the week in markets and a bit of a special topic overall. Buy the dip. This one, look, if you're holding S&P index ETFs, you should definitely have a look at this. It's available to wholesale and retail. Very capital efficient, very well risk managed. It optimizes entry. Just as I say, if you're holding these index ETFs or FANG or Nasdaq or whatever, same sort of thing. Just at least go and have a look at it. I know structured products and structured investments are new things to many people, but this is a great way to maximize your capital. Have really good risk management, and smooth your risk out a little bit, and then obviously optimize your entry. There's a whole bunch of reasons why you should do it. And if not this time, you can do it next time. But go and have a read. Go and have a read of it. nbcinvest.co, buy the dip, or actually just go to the homepage. The information's there. If you do want to invest in this July one, particularly if you're retail, we only run the retail version of this, a couple of times a year. So probably have a look pretty soon. And it's just on the homepage. Go and find out about it. It's a really good product. It's selling really well. And people are quite liking it. And you sort of dip your toe in the water and test it out anyway. So, but yeah, we had some pretty big news this morning ahead of the AGM from Macquarie. CEOs resigned there. And then we've got the succession. They announced a new CEO, Greg Ward. They announced that ahead of the thing. There's no real major news on it. We've got employment today as well. Expecting up 15,000 jobs and unemployment rate at 4.4. SPI was up around about 70 odd points, which is fair enough. Because oil and commodities were looking really good, and we don't have a massive tech sector, so yeah, we'll probably hold in there a fair bit better than the rest of them. South Korea's got advanced GDP. We've got Intel earnings tonight, ECB rate decision, so fairly full calendar. But yeah, pretty busy day. Apologies for being a little bit late, and guys, we'll speak again tomorrow. For those of you on LinkedIn who want to follow us on LinkedIn, my monthly newsletter's out this morning as well. Pretty good quick read, bit of a wrap up of July and how we're playing the months coming forward. So plenty of things out there for you to read and get your house in order in terms of your portfolio. Thanks for joining us. We'll speak again tomorrow.